In this video, we'll be looking at debt consolidation versus balance transfer. So let's get started. Now, first of all, we're going to be looking at debt consolidation and its key features. All right. So the first key feature that we have is process. Now it combines multiple debts into a single loan, typically through a personal loan or home equity loan. Now the loan is used to pay off existing debts, leaving you with one monthly payment. Then we have eligibility. That requires a good credit score to qualify for loans with favorable interest rates and is suitable for those with stable income and higher debt amounts. Then we have costs. Now, interest rates depend on your credit worthiness, typically lower than credit card rates, and it may involve origination fees or closing costs. Then we have impact on credit. Now, opening a new loan may cause a slight temporary dip in your credit score due to hard inquiries, and then consistent payments can improve your credit score over time. And lastly, we have time frame. Now, repayment terms vary, typically 3 to 7 years for personal loans. Now we're gonna go ahead and look at the pros. So the first that we have is it combines multiple debts into one manageable monthly payment. It can reduce interest rates compared to credit cards and it offers fixed interest rates and predictable repayment schedules. Now we're gonna go ahead and look at the cons. So it requires good credit for favorable loan terms. It does not eliminate debt but reorganizes it. There's risk of fees and higher total cost if the loan term is long. Now that is it for debt consolidation. Now we're going to go ahead and look at balance transfer and we're going to be starting by its key features. So first we have process that involves transferring high interest credit card balances to a new credit card with 0% introductory APR for a promotional period which is usually 12 to 18 months. It helps pay down principal faster without accruing interest during the promotional period. Then we have eligibility that requires excellent to good credit to qualify for balance transfer cards with 0% APR offers, and it often has limits on how much debt you can transfer. Then we have costs. Now there is a balance transfer fees which is typically 3 to 5% of the transfer amount. And then standard APR applies after the promotional period ends if the balance isn't paid off. And then we have impact on credit. Now, opening a new card can cause a temporary drop in your credit score due to a hard inquiry. And then lowering your credit utilization by paying off balances can improve your score over time. And lastly, we have time frame. Now, the promotional APR period is typically 12 to 18 months after which standard rates apply. Now we're gonna go ahead and look at the pros. Now there is 0% interest during the promotional period, allowing faster repayment of principal. Then it simplifies credit card debts into one payment and it may improve your credit utilization ratio. Now we're gonna go ahead and look at the cons. Now fees can offset savings if the transfer amount is large, and failing to pay off the balance before the promotional period ends can result in high interest charges. And lastly, we have lower credit limits may not cover all your debt. So alright guys, that'll be it for the video. I hope it helped you out and I'll be seeing you guys next time. Peace out.